name's Cameron Ripley. I am the broker owner of Purpose Home Loans and Purpose Home Lending. We are licensed in California, Colorado, Texas, South Carolina, Florida, Alabama, working on Tennessee and New Jersey, but not licensed there. But we are licensed in 47 states to do commercial loans or investor loans, with the exception of just 3 different states. I always forget which ones they are. I think it's South Dakota, North Dakota, and West Virginia, or maybe Vermont. But the talk today is on VA loans, whether you're an active duty military member, reservist, National Guard, Air Guard, currently serving, or a veteran. That's what this talk is, and how you can dominate the real estate market. Our company NMLS is 2613494. My personal one is 2314695. We are, of course, an equal housing opportunity lender, and I'm happy to help anyone who is a veteran, or really anyone just looking to buy, invest, whatever it might be. So we'll go ahead and get into it. I always like people to start off with their own purpose and vision. So, at Purpose Home Lending, we're a mortgage company that really focuses on the purpose and vision, because our job, yes, it's somewhat sales, but really I could never convince you to sign up for something that you would not want to sign up for, and that really is not a benefit to you. And the reason I like to say that is I'm here really to be your representative. We have so many different disclosures that go out, so you're aware of, fees lenders charge. I mean, yes, some have you sign things before you get a chance to read them. But, we are really here to be your representative. Whatever your goals are, that's what we try to embody, and what we try to keep in mind when we are going through and figuring out the best solution for you and your future. We do like to, talk to people more one-on-one to figure out, because everyone's situation's different, everyone's goals are different, but we like to schedule one-on-ones to figure out what works best for you. So as we go through the presentation, I'll have our calendar link with Calendly, so you can schedule a one-on-one call with either me or one of our other experts on VA loans, or just regular investor loans, other, first-time home buyer programs, whatever it might be that you're looking for. That way we can get a better idea how to really scale your own real estate portfolio. What is your risk tolerance? Where are you located? Where are you willing to invest? But we're going to also get into some of that stuff as well. So one of the things we really like people to spend some time thinking about and writing out is, where are you currently at? Current income. How much do you currently make gross? Unless if you're self-employed, then they'll look at net. They, as in any lenders that we submit loans to or broker loans to. Do you need to make more money? That's something we'll always evaluate with people. I've had clients that they're doing great if they could just add on a little bit extra income, regardless of what that is or where that is. I've helped people get promotions at their jobs that they could buy the very next year, or sometimes 6 months later. What's left over after you pay your bills and you get paid? That is a big factor that's played into VA loans, because the way that they calculate your income is very interesting, and today's talk is on VA loans. That's something to really keep in mind. People like to say, I don't want to buy a house I can't afford. Lenders will not let you buy a house you can't afford. However, VA loans, they're a lot more lenient than most other loan programs out there, so that you can get yourself in somewhat of a tricky situation. But once again, they do take into account, for VA loans specifically, they call it residual income. So it's what's left over after common expenses. So it can be a little tricky. We're not going to go into how they calculate it, just so you're aware. Let's say you make $8,000 a month. There's a good chance that they may calculate it after all of your home payments, what is left over, and that's a ratio that they use to help qualify. Okay, money saved. How much do you currently have saved? Where do you have money saved? Is it a retirement account that you could do an early withdrawal from, or borrow money against? Is it just in a savings account? Are you working on saving money? Because I have definitely helped a lot of people open up a like a Fidelity mutual money market account where the money just sits there, but it grows much faster than a traditional savings account at a bank. And that way they can start to save more money. Do you have equity in your home that maybe you could do a home equity line of credit? That way, if you're kind of in a rush to buy another place and you'll eventually pay off that equity that you borrow against, that can be great too. But we'll try to give people as many options as we can with side-by-side comparisons for each situation to say, listen, I know that you heard a home equity line of credit's a good idea, but I want to show you the pricing difference between that and maybe a cash out refinance or just selling your property. Here's the difference. And sometimes when you see it side by side with multiple options, you realize, okay, I need to go with this over the one that I had read about on the internet. This seemed like the better idea. A big one for me is your time and availability. How much extra time do you have in your week? How much mental strain and stress can you take on? And what are your non-negotiable time commitments? So when I bought my first house, I truly believed that I could just spend all day and night renovating the house that I bought. So I bought a fixer-upper. I realized very quickly that I had a lot of other things that I needed to do. I was a real estate agent at the time and then getting my mortgage license. And so I was spending a lot of time renovating things when I should have been spending time focusing on selling, because my income made so much more. It was so much more better of a payoff in investing time into my real estate business than into renovating my house. If I would have spent more time in my real estate business, I could have paid someone to renovate the house, and the trade-off would have made a lot more sense. And so that's what people got to pay attention to. We get people all the time who will say things like, oh, I'm really handy, I think I want to fix it, but they've got kids. They've got a significant other they want to spend time with. They've got volleyball league. They've got pool, billiards league or poker tournaments, whatever it might be. Make sure you're understanding where your position's at, because if you don't have a lot of time, then we shouldn't be buying a fixer-upper. If you don't have a lot of extra income, definitely shouldn't be buying a fixer-upper, and that's okay. We have plans for someone like you. There's some key concepts and key terms and misconceptions I always like to go over. Equity is the difference between the debt that is owed and the current value of the property, but this is not free money. It's just unrealized money. So if you hear all over the internet, social media, you just got to be very careful of a lot of the gurus trying to sell coaching programs or really getting you to invest in one thing or another. You got to be careful of the people who say, not to say that they're completely untrustworthy, but if they quickly go to, hey, you're sitting on free money that you're not utilizing, well, that's a bunch of BS, because the second I take a loan out against my equity, it's not free. I owe it back. If I sell my property because I have a lot of equity and I use it, well, I still need another place to live. So it's not free. And just be very aware of that. Okay. PMI and down payment. Most people do believe that they need 20% down in order to buy real estate. Others believe you should never have PMI, which is, premium mortgage insurance, or just mortgage insurance. We'll just call it mortgage insurance. But how much do you really need to put down? How much is the PMI or the mortgage insurance? We're talking about VA loans because this is one of the biggest benefits I don't think people understand. They think, oh, I could buy a house without putting any money down. Yes. And on top of that, you don't have mortgage insurance, where, because the VA is insuring the property for the lender. You still have to get homeowners insurance. But when I look at an FHA loan with a down payment assistance program, I still have mortgage insurance, when I look at a USDA loan and I do 100% financing, I still have mortgage insurance. This is the huge benefit of a VA loan and why I'm doing this talk today. Appreciation. More often than not, appreciation is overlooked in the long-term goal setting. A lot of people will say, okay, well, should I do a 30-year mortgage? I don't know if I want to spend 30 years paying off this mortgage, and they totally forget that your value goes up over time. In a 10-year period, the average appreciation is typically around, right now, 5 to 8, 9%, depending on the area. When I'm doing long-term planning with people, I don't pay a lot of attention to, okay, in 5 years, you've paid your mortgage down to this. I actually really don't even calculate that in. I pay way more attention to, you've taken care of your property, and so the value goes up. You might hear my daughter in the background, by the way. But the value goes up, will go up this much over time, which that's the value of owning a property. A lot of times people will come to me and say, well, it doesn't make more sense to rent or to buy. Well, to buy, not because you're saving more money, because that's definitely not going to be the case. But you have certain tax advantages when you're buying a property, and you have the ability to have your home appreciate in value. Appreciation is usually a percentage. So let's say I take 7% in an area I'm in. It's of a large amount, right? So if I buy a home for $500,000, people think, whoa, that's $500,000. No, it's $500,000, but I'm appreciating at 5%. If I bought a home somewhere else in the United States for $150,000 just because I thought, oh, this is cheap, it'd be nice to buy it. Well, 5% appreciation on $150,000 doesn't have as much growth as buying a home for $500,000 at 5% appreciation. So if I can afford the house, I'd rather go for the bigger house, because I'm going to have so much more equity in the future that then I can use, and make it realized equity at some point and sell it and either do, exchange to another property or whatever it might be. Maybe that's my startup fund for a business. I've had a lot of people do that too. Okay, building equity is the same as adding value. So whenever I look at a property with someone, I look at, okay, how are we going to build equity in this property? So we're going to add value to the property, and that's going to build equity. A lot of times people will say, well, I'm going to keep putting an extra $5,000, $10,000 down towards my mortgage every single year so I can pay off my mortgage. The problem is if you don't spend time upgrading your house, your value is going to be so much significantly lower than other properties in your area. For instance, I had a seller who she worked really hard to pay off her property, but never renovated it. Her house, let's say the same exact house, sorry, the recording cut off there, but going back into our presentation, the same house, if it was renovated, which this happened. So the same exact house was renovated right down the road. And my client decided, hey, she said, hey, well, how come my house is not selling for as much as this? I think her house, the value we could get was $425, but that other house was listed and selling for and getting offers over $500,000. That's how big of a price difference it was because it was renovated. And we finally realized that if she would have spent some time over the years making the renovations herself, the cost would have actually been a lot better. So just something to keep in mind. Okay, cap rate and cash on cash return. When people are looking at investment properties, be very careful of what you read on the internet. Okay, cash on cash return is something that I like to pay attention to than just my return on investment. If you're looking at advertisements for listings, just be very wary that they might, agents are great. I'm still a licensed agent in California, but a lot of them don't exactly know how to advertise properties because they don't have rentals. So they will say that something has a cap rate, but they're basing it off of the gross operating income versus the net, which can be fine if you're using the income the property's producing in order to qualify for a specific loan. Next is tenant issues. I get a lot of people who are really afraid to build a portfolio of properties because they're afraid of tenants. They think that tenants are terrible. And they hear all these horror stories. Every single horror story from my clients, I always ask them, that I've heard, I always ask, did you do any tenant screenings or have any pre-qualifications? The answer is always no. For me, every time the answer was no. I didn't do a background check. I didn't do a credit report. I didn't do a verification of their income. And then what tends to happen a lot is that they, with the tenants, they end up listing their property for way more than they should have. And so they just found someone who was desperate. The problem is that person ended up getting very, losing out on their money, and it became a huge issue. Plus, they failed to communicate with the tenants. If you can just communicate, it makes it a lot easier. Now, I'd rather have a quality tenant over just someone who's available to pay a higher rental amount. The next thing I like to focus on is always the upside potential, not just the current potential of a property. That is a big mistake a lot of people make. because they don't look at, okay, this property is being valued at this, but what if I did A, B, C, which we're going to talk about today, in order to get it to where I really want it and make it super valuable. And so when we look at properties, we don't just look at the current value, but also the upside potential. If there is no upside potential, then obviously that may or may not be a good deal. Is it really passive income? That's what you have to determine for yourself, right? When you look at investing in different properties, you have to think, okay, how passive do I want this income? I've known many people who it's very active because they do all the property management themselves. They buy fixer-uppers, they renovate them, but they get to a point where their portfolio is so big that they are able to hire property managers that can handle everything. And when they get a little older and they're tired of dealing with even the property manager, they're able to sell the property, all the properties, the whole portfolio, and do a 1031 exchange, which just means they defer their tax basis, and they buy into something called a REIT, or a real estate investment trust, where it's a little bit more publicly traded and they're just getting dividends, and that becomes a lot more passive, little less return, but much more passive, which is something I've always aimed to do. Just getting started, do you start small or start big? So this is our QR code for our calendar link. I really encourage people, if they want to schedule a one-on-one, please do. Everyone is different. Once again, I talked about as values increase, they increase as a percentage of a property. And so if you start off really, really small, because that's what a lot of people looking to invest in real estate think they should do, is buy the cheapest property in the middle of nowhere, America. Well, that's going to be 5 to 7% appreciation on that small amount. If it's $100,000, that's $5,000 a year. If it's $500,000, that's $25,000 a year, right? So whether you should start small or start big is dependent on your situation. Okay, VA home highlights. 100% financing. You have the ability to 100% financing. One thing I didn't add on here is you can get up to a 6% credit from the seller. Doesn't mean you're going to. Let's be crystal clear about that. But if you needed to, you could get up to 6% to cover the closing costs, to cover a lot of other fees associated with purchasing the property, because there's still going to be closing costs, and we'll talk about that in a second. But 100% financing, and you don't get mortgage insurance. Could you put something down on the property? Absolutely, but you don't have mortgage insurance. You do get better interest rates as of right now with VA loans. I want to say in 2020, it was pretty even between FHA, VA, and conventional, maybe 0.25% better. If you see my videos, because my daughter's looking at me, she's here sick today in the office. Right now, it's extremely better interest rates because the market is very volatile, and the lenders and investors like that the VA is insuring the property. If you have a disability rating, you have the ability to waive the funding fee. So the VA, in lieu of there's reasons why they have a funding fee, which I won't get into, but basically in lieu of mortgage insurance, they charge you a funding fee. That can be 1%, 1.5%. If you have multiple uses, so you use your VA loan multiple times, hint, hint, that's also a huge benefit that most people don't understand, is their benefit is using the VA loan to acquire the property, not keeping the VA loan. And you can use it multiple times. You do have to occupy the property yourself and be in there 6 months, okay? Otherwise, it's mortgage fraud. But that means you could buy 2 properties a year. There are many people who think you can buy more. There might be reasons why you can or cannot, but let's just stick with you cannot. We can always look into, there are some reasons, and I'd have to really dive into it case by case, that you might be able to buy more. I just wouldn't get in the realm of mortgage fraud, because that's like a $3 million fine and jail time. So multiple uses. If you have a disability rating, they'll waive the funding fee. So that's a huge benefit for a lot of people. Depending on your disability rating, in a lot of states like Texas and Florida, they'll waive your property taxes or really lower your property taxes. You could buy properties 1 to 4 units. That means if you're buying a duplex, a triplex, or a quadplex, and you're going to live in one of the units, you can use the income the other units are producing in order to help you qualify. The other big thing I like to bring up is that the rule used to be with the VA that you had to have a cleared section 2 or section 1. I think it's cleared section 1 pest report or wood destroying organism report, which usually meant that the seller had to pay for all the rotted wood around the house to be replaced and for them to give a cleared report. This screwed over veterans because if I'm submitting an offer against a conventional loan that doesn't require that, who do you think the seller is going to choose? The person who's making me fix my house, the lender who's making me fix my house when I don't have to, or the person who's not even asking me to fix my house. Okay. So they changed the rule, but a lot of people are not aware of it because they don't announce it to any of us. They just changed the rule and put it as a bulletin that you have to Google to find. There is now a form. So you'll see a lot of properties that are sitting and not selling. And they will say, oh, we cannot, our property will not qualify for VA loans. I always like to say, is there something that's a health or safety concern? Because if it is, it probably would get called out for conventional, or just major signs of dry rot. Like an appraiser walks a property and just goes, oh my gosh, this post is clearly rotted through. A lot of times they say no, but my seller doesn't want to give a cleared pest report. I go, awesome. You don't have to, because that is not a guideline anymore. Now we submit this form called an NPMA 33, which just says there is no active pest, as long as there is no active pest, right? But I have had clients win over deals where it's a great deal where the listing agent was not advertising it properly because they just weren't aware that that guideline had changed. So there's a lot of opportunities out there, and we like to help people with that. Choosing the right market, once again, please schedule time to talk with us, because this is the most important factor to me, because I've dealt with a lot of investors over the years who, once again, just try to buy the cheapest property, but just don't pay attention to things. I'm in California, so I'm in the Sacramento area, and I do believe, let me make sure it's still on. I do believe that, we get a lot of people who throw a fit because people from San Francisco or LA come and buy our properties for cash. They sell their 2-bed, 1-bath condos for $1.5 million. And then they buy, I hate that Google Meets does that, $1.5 million, and they pay cash for a house out here in Sacramento. I'm sure people in other states are very frustrated with Californians doing the same thing. There's a reason why people are buying those really expensive properties. It's because values are still going up, but you have to look at the job market. You have to look at unemployment rate. You have to look at, is the area median income increasing or decreasing? Because that's going to be a big significant thing for me to look at when I'm evaluating a deal. Is there local business growth? Yes or no? If I'm looking at a market and I see there's no business growth, it's actually declining, area median income is declining, and unemployment is on the rise, it's going to be hard for me to buy a property and be able to rent it out for what I want to rent it out for. Okay, now we're going to dive into some deals. So this is a property currently listed, 909 East Costilla, or Costilla if you're Italian, Street in Colorado Springs. This is a duplex, so they're asking $475,000. It's 2 units, so each has 2 bedrooms and 1 bathroom. Total of, and pretty much split 50-50, 1,968 square feet. One of the units, as you can tell in the picture on the bottom, is renovated. The other is not, but and the pictures are pretty terrible. But I do believe it's rented out right now, and so it's old pictures. So you can use some of the income that side is bringing in. What I would do with this property is I would go and I would buy this with 100% financing, knowing that I need to set aside some money to renovate that other side at some point. I would live in this renovated side until the other tenant leaves, or I can find a way to get them out in an ethical, okay way. The way you do that is you increase rent for how much the state allows, right? You don't push people out. If they're a good tenant, then don't do it. You can always ask them if they want to switch sides. And then when you're increasing rent, this is what I've done in the past. I live in the good side and I tell them, hey, would you like to pay the same amount and live in this renovated side? I would like to be able to renovate the other side. And they'll say yes. Now, every year when I go to increase the rent, maybe 5% or 3 to 5%, don't do more than that. It's crazy. it's easier for them to justify it because they're living in a renovated unit, whereas other places are not. If I keep increasing rent 3 to 5% or 10%, like people are trying to do out in California, the problem is they're going to look at it and say, you mean this piece of crap? And then they're going to squat and they're going to beat up your property and they're going to get really angry. So it's easier to justify when they're living in the renovated side. But I'm going to renovate both sides. And I'm going to, at 6 months, I'm either going to move out and I'm going to get just a temporary place until I can find another one and put in another tenant or whatever it might be. I'm going to scale up, right? I'm going to add another duplex or a triplex, whatever it might be. Now, the average home now, I do want to point out closing costs. So I like to tell people it can be anywhere depending on, the credits we're able to give at the time you're buying it, lender credits. Of course, there's seller credits you can get to cover all the closing costs, but I like to estimate anywhere from 1% to 3%. Sometimes it could be more. So you're looking at maybe $4,750 to $14,250 out of pocket. That can depend if you want to lower your interest rate. I mean, there's lots of things. If this is a subsequent use, so you're using your VA loan multiple times and you don't have a disability rating, here's the cool thing is if this property's sitting, we could always ask for a credit to cover it. So let's say I asked for a $14,000 credit and I increase the purchase price, my monthly payment is going to hardly change as long as the property appraises. So there's a lot of strategies we can take if you don't want to be spending any money out of pocket. That's why I like VA loans. For our veterans and me as a veteran too, it's really nice to have. Okay, average appreciation in Colorado Springs right now, this is over a 10-year period, is 8.6%. You have a huge base, Fort Carson. That's where I was stationed, so that's why I'm doing this video. Huge base. So you have a lot of potential for a lot of renters, or just people looking to buy. By year 2, you're looking at an increase in value of $515, $850. Year 3, $560. Year 5, $660. And an ability to rent out each unit anywhere from $1,475 to $1,700, which is what I like to look at. Now, how do I get the higher amounts? People want backyards. They want a place to let their pet out if you allow pets. Just a place to be able to go. So if you see in the top picture, and this is why I chose that top picture, if you can find a way to section off some backyards for people to give them a little bit more privacy, they will pay a lot more. And the cost to do that is very insignificant compared to the increase in rent that you can now advertise because they get their own backyard. Here's another one I like to look at because we did have some people that I believe signed up from San Antonio. They sent me some messages and asked about the San Antonio market because there is a big base there. It's a joint base. I think it's called Fort Sam Houston or something like that. There is a lot of upside potential. So right now, average appreciation is lower, so 7%. However, the job market is booming in San Antonio. Gotta make sure it doesn't. And it's really growing, and area median income has been increasing at an insane amount. Maybe not insane, but a really good amount. So I really think that San Antonio has a lot of potential. What I like about this property is they're asking $650. I think they're a little high, but that's up to you and what you think you can get out of the property. Both sides are I believe are vacant, and it's just staged. One side might be occupied. They might have been using one side as an Airbnb. So if you could afford to buy one side and Airbnb the other, you can't use the Airbnb income to help you qualify unless if it's been recurring for 2 years, because it's essentially like a business. So short-term rentals are like a business. But this backyard is exactly what I was talking about. If you can make something valuable where a tenant can feel like clearly the owner of my property cares about this property, then they will also care about the property. So you make it terrible, they're going to treat it terribly. But this is a great Airbnb potential if you can afford to qualify on this property. Now, if you get a disability rating, so let's say I get disability pay from the VA, I'm at 100% rating, they count your income much higher than what you actually get paid because your pay goes up every year. And there's reasons for that too. The other thing I like to point out is they made this is a pretty affordable way way to make the backyard nice. I mean, these chairs are very inexpensive. Yes, there's a barbecue. They just put some gravel, a little section of grass, a San Antonio, Texas sign. I mean, how much does that really cost? A screen. There's no projector, but someone can bring their own. They have a little blown up hot tub, green sign just to make some ambiance. Now this kitchen, this is butcher block countertops. They're really not that expensive. And if you have to put it, like I put them in my house myself, this sink is easy to install yourself as well, because you don't have to cut wood and whatever. It's nice to see that, people really care about this because it looks nice. And so your tenants will pay more. Your Airbnb people just like something cool and unique on their vacation. So if that's what you're going for, it really will pay off. Okay, and then the last deal we're really going to go over today is when you're buying a lot of these properties and the way we help people scale up. And so this is a client who had requested, he had 2 duplexes, same thing. He used a VA loan over, I think he spent 5 years doing it for some reason, just work got busy. But he spent 5 years getting the duplexes, even though it could have been 1 year. But he had them for, I think, about 7 years. And he decided, hey, I'm going to sell them off. And I really want to scale up because I want more units. The nice side about more units is if there's more vacancies, it doesn't affect me as much. So if I have 2 units that are vacant, well, that's just a little bit less income. When I have 1 unit vacant on a duplex, there goes 50% of my income, right? So this property, this is a deal that we analyzed for him. So the asking price was $2,250,000. He probably never thought he would be able to buy such a big property. Okay. You have to make sure Google doesn't log me out. Now 20% down. So he sold both properties and did a 1031 exchange, which meant he did not touch the money. An asset management company touched the money and they helped him with all the tax stuff. But he put $450,000 down. He used a little bit extra because he had way more. I think he had about $800,000 in equity, and he wanted to originally pay cash for an apartment. And I just looked at this with him, and this was a game changer. So he used a good amount down. So he put 20% down. He used the rest to cover the closing cost, or some to cover the closing cost. I don't know why it says negotiate down to 3.1. I think that was supposed to be $2,150,000 is what he negotiated it down, because his capitalization rate was 9.17. So the principal, interest, taxes, and insurance for him specifically at the time when he bought this was $13,218 per month. However, the current rents, and this did have 2 vacant units, with the 2 vacant units was still $17,200 a month. So he was cash flowing, roughly $4,000 a month. However, when he went in and he renovated the units, I haven't touched base with him in a while. I do believe he said that he is now at a point, it's about a year and a half later, where he's cash flowing $10,000 a month. This is still growing in value as well. So you figure if values continue to go up, so his goal, minimum required outside income. So by the way, when he bought this, he didn't use any of his own income to qualify because it had a debt service coverage ratio loan, and the ratio was 1.30%. So he used only the income of the property in order to qualify. His target sale price, once again, I don't know why it's saying this. He actually really wanted to scale up again. He wanted some more renovations, but he still has this property. So he had a goal when we originally talked that he wanted to increase rents for about a year or two by 3% and renovate the 2 units. And he was going to sell and have this much equity in order to buy a $4 million 26 unit apartment complex. However, this has been cash flowing so much that he decided not to, and he's just going to refinance when rates drop. And then his principal, interest, taxes, and insurance are going to go dramatically down, and it's just going to be extra cash in his pocket. So this is a lot, and I really like to schedule one-on-one calls with people because, once again, we can really help a lot of people scale up a portfolio. It's crazy. I had this single mom veteran, just rough circumstances, but had a decent, got a decent job, worked on her credit. The VA loans are very lenient on your credit. So I think she only got up to probably a 620 credit score. So she was still able to work with some of the more prime lenders. and buy her first multifamily. And we were really working on her portfolio from there. And it's just really nice to see. So I like to be able to plan this stuff for people. We can always shop for you. So we have lots of lenders to fit most circumstances. You can't have all of the cards stacked against you, but we can always help with that if it does seem like I've got terrible credit, no income, no job. We can help figure out something for you. What we like to do is we do like to source deals. We're very good at finding on-market and off-market opportunities because we do constantly network in all of the states we work in. And so if you're looking online and getting frustrated and feeling like there's nothing available, there's no good deals out there, hire us. And I'm going to call BS. There are good deals out there, but let us really help you, unless if that's just going to be your full-time job is finding deals, which I don't think it is. So this is our full-time job. Let us help you. Once again, we can shop multiple lenders too. So if something doesn't seem like a good deal, we can find a lender that may have a program that'll make it a good deal. But yeah, that's pretty much it. I appreciate those of you who were able to make it on the call. If you're watching the recording, thank you as well. But please scan the QR code and schedule a one-on-one. We don't pull people's credit unless if they feel they're absolutely ready to go. Usually we start off maybe with a soft pull because we pay for that out of pocket. I don't want to be pulling credit left and right. And so, talking to us is not going to hurt you in any way. We're here to be your representative. So hope everyone enjoyed this, and please email me if you have any questions, and thank you for joining.